Assalamu alaikum. Welcome back to our channel Accountancy. Today we will discuss about bank reconciliation and the items that cause differences between the balance of cash book and the bank statement in detail. The first question is, what is bank reconciliation? Bank reconciliation is a statement that is prepared to compare the balance of cash at bank account with the balance of bank statement and explains the reasons for differences between them. This means the balance in the bank account column of cash book and the balance of bank statement should always be same. But sometimes differences may arise due to which balance does not match. So the bank reconciliation statement is made to reconcile the balance of cash at bank account and the balance of bank statement and to correct any differences that occur between these balances. Before moving forward, there are certain things that you have to keep in your mind. The first thing is the bank viewpoint is different from the business viewpoint. Bank make the bank statement according to their own view. Business viewpoint. According to business point of view, if the balance of bank account is positive in their books of accounts, then this is the asset of the business and it is the debit balance. But if the balance of bank account is negative, that means this is an overdrawn balance. This means the business owes money to the bank and this is the liability of the business and it is a credit balance. Bank viewpoint. From bank point of view, if the business bank account balance is positive, this means the bank owes the business money. So the bank show it as a credit balance in the bank statement. If the business bank account balance is negative, that means a bank account is overdrawn. Then from the bank point of view, they have an asset and they show this as a debit balance in the bank statement. So while making a bank reconciliation statement, the debit balances of cash book will be compared with the credit balances of bank statement, and the credit balances of cash book will be compared with the debit balances of bank statement. Now I will discuss about the possible differences that may arise between the balance of cash at bank account and the balance of bank statement and their treatment. The first category of differences is items recorded in the cash at bank account cash book but have not yet shown in the bank statement. This means that the business have recorded the items or transaction in the cash at bank account in the general ledger or in the bank column of cash book, but these transactions are not yet recorded by the bank. Treatment of these items. These items will be corrected in the bank reconciliation statement, but no changes will be needed in the general ledger of cash at bank account or in the cash book. Two types of transactions fall in this category, so we will discuss them one by one. The first one is outstanding lodgements. This means that the business have received the checks from customers and also recorded them in the cash book, and after that business entity have deposited the checks into the bank, but these checks have not yet been processed by the bank. In bank reconciliation statement, we can treat this difference in two ways. First method, when cash book has positive debit balance. If we are starting our answer by taking positive debit balance of adjusted cash book, then we will deduct the amount of outstanding lodgements from this balance because business unit has recorded this transaction in its accounts, but the bank has not yet recorded it. when cash book has overdrawn credit balance. If we are starting our answer by taking an overdrawn credit balance of adjusted cash book, then we will deduct the amount of outstanding lodgements from this balance. Because when the business unit have received the check from customer, the business unit has recorded it and debited the cash book by this amount. But the bank has not yet recorded it. So now the business unit will credit its cash book balance by this amount by deducting this amount from the balance. But as you know, here we have overdrawn credit balance, so both the credit or negative balances will add up. Second method. When bank statement has positive credit balance. If we are starting our answer by taking the positive credit balance as per bank statement, then we will add the amount of outstanding lodgements in it, because the business unit have already added this amount in their bank account balance, but the bank have not yet been recorded it. So now we will add this amount in the balance of bank statement to correct the difference. When bank statement has overdrawn debit balance. If we are starting our answer by taking the overdrawn debit balance of bank statement, then we will add the amount of outstanding lodgements in it, because the business unit has already added this amount in their cash book bank account balance. So now the bank will add this amount and credit the business unit bank account by this amount. Here the bank statement shows a debit balance, so we will deduct the credit balance from the debit balance. The second transaction that fall in this category is unpresented checks. This means that the business entity has issued the check to the supplier and recorded it in the cash book as payment, but the supplier has not yet presented the check into the bank for payment. Or if the supplier has presented the check for payment into the bank, then the bank has not processed the deduction from the business entity account yet. In bank reconciliation statement, we can treat this difference in two ways. First method, when cash book has positive debit balance. If we are starting our answer by taking the positive debit adjusted cash book balance, then we will add the amount of unpresented checks into this balance, because the business entity has recorded it as a payment into their accounts after issuing a check, but the bank has not yet been deducted the amount from the business entity account. So the business entity will add up this amount into their bank account balance in order to match the balance with the bank statement. When cash book has overdrawn credit balance. If we are starting our answer by taking the overdrawn credit balance of adjusted cash book, then we will add the amount of unpresented checks into the balance, because the business unit has recorded it as payment and credited its cash book by this amount after issuing a check, but the bank has not yet been deducted the amount from the business account. So now the business entity will add up this amount into their bank account balance and will debit its cash book by this amount. But here we have an overdrawn negative credit balance of cash book, so the debit positive balance will be deducted from the credit negative balance. Second method, when bank statement has positive credit balance. If we are starting our answer by taking positive credit balance as per bank statement, then we will deduct the amount of unpresented checks from the balance, because the business entity has already issued the check and recorded it as a payment, but the bank has not yet deducted the amount from the business entity account. So now the amount of unpresented checks will be deducted from the balance of bank statement in order to match the balance with business bank account. When bank statement has overdrawn debit balance. If we are starting our answer by taking the overdrawn debit balance of bank statement, then we will deduct the amount of unpresented checks from the balance, because the business entity has already issued the check and recorded it as a payment, but the bank has not yet deducted the amount from the business bank account. So now the bank will deduct the amount of unpresented checks from the business bank account and will debit the business bank account by this amount. So as here we have overdrawn debit balance of bank statement, so both the debit balances will add up. The second category of differences is items in the bank statement that have not been recorded in the cash book. This means there are certain items that the bank records in the bank statement and debit the business bank account by that items, but the business entity do not know about these items until they receive the bank statement. Treatment of these items. When the business receives the bank statement and know about these items, then the business entity include these transactions or items in the general ledger, cash at bank account, or in the cash book in order to correct their balance of cash at bank account. And then this corrected or adjusted business entity bank account balance will be used in the bank reconciliation statement. Now we will discuss the items that fall in this category. The first item is bank charges. Bank charges is the amount that the bank charge the business for the provision of their services. Method of treatment. When cash book has positive debit balance, the amount of bank charges will be deducted from the business unit cash book balance because the bank has debited the business bank account with this amount in the bank statement. So now the business unit correct its bank account balance by crediting the bank column of the cash book by this amount. Then the corrected or adjusted business cash book balance will be used in the bank reconciliation statement. When cash book has overdrawn credit balance. If the bank debited the business bank account with the amount of bank charges in the bank statement, then the business entity will credit the amount of bank charges from their cash book bank account balance. So both the credit negative balances will add up. The second item is bank interest on an overdrawn balance. Overdrawn balance means that the business entity have spent more money than the business entity have in its account, and now the business entity is in debt to the bank. So the bank charges an interest on overdrawn balance. Method of treatment. When cash book has overdrawn credit balance. If the bank charges the business entity interest on its overdrawn balance and debited the business entity bank account with this amount in the bank statement, then the business entity will credit its bank account balance in the cash book with this amount in order to correct its bank account balance in the cash book. So both the negative credit balances will add up. The third item is the dishonored check. Dishonored check means customer may have insufficient funds in their bank account to clear the required amount of payment. So when the business entity received the payment from the customer in check and deposited it into the bank, then the bank rejected the payment due to insufficient funds. Method of treatment. When cash book has positive debit balance. The amount of dishonored checks will be deducted from the balance of cash book bank column, because when the business entity receives the check from the customer, the business entity had debited the bank column of the cash book by this amount. But when the check will be rejected by the bank and become dishonored, then the business entity will credit its cash book bank account balance by this amount. When cash book has overdrawn credit balance. If the check becomes dishonored and the bank does not credit the business bank account by the amount of check, then the business entity will credit its cash book bank account balance by the amount of check. Because the business entity has already added this check in receipt side of the cash book and already debited the cash book bank account balance by this check. So now the business entity will credit this dishonored check, so both the credit balances will add up. The next item is the bank interest received on a deposit account. Sometimes a business unit receives an interest amount against the money deposited in the bank, as the business unit is unaware of such transfer because it may not know the exact date and the amount that is transferred as an interest in its account unless it receives the bank statement. It cannot pass any journal entry for such transaction. So the cash book balance differs with the bank statement balance. Method of treatment. When cash book has positive debit balance, the interest received amount will be added in the business unit's cash at bank account balance or in the bank column of the cash book, because the business unit may not know about this transaction unless it receives the bank statement. So when the business unit know that the bank has credited its account by the amount of interest received, then the business unit will debit its cash book balance by this amount, and then both the debit balances will add up. When cash book has overdrawn credit balance. If the bank credit the business entity bank account by any amount of interest received, then the business entity will debit its cash book bank account balance by this amount of interest received. So if our cash book has overdrawn credit balance, then this debit balance will be deducted from the credit balance. The next item is withholding tax and other kind of taxes. Withholding tax is a deduction made by banks or other financial institutions on interest or dividend paid. The accountant at a business unit may not aware of such tax and the date of tax deduction, so he cannot pass any journal entry for such transaction unless he receives a bank statement. This also causes a difference between bank statement and cash book. Method of treatment. When cash book has positive debit balance, the amount of tax paid will be deducted from the balance of the cash book or general ledger cash at bank account balance, because after receiving the bank statement, the business unit will know that the bank has debited the business unit bank account by the amount of taxes paid. So now the business unit will credit its cash book bank account balance by the amount of taxes paid. So the credit balance will be deducted from the debit balance. When cash book has overdrawn credit balance. If the bank debited the business bank account by the amount of any taxes paid, then the business entity will credit its cash book bank account balance by this amount. So when the business entity have overdrawn credit balance of cash book, then both the credit balances will add up. The next item is a direct deposit. Direct deposit is a bank transfer where a payment has been made directly into the business account. This means the payment is made electronically into the business bank account rather than through a physical paper check. The business unit will not know about the person or customer who made the payment unless it receives the bank statement. Method of treatment. When cash book has positive debit balance, the business unit will add the amount of direct deposit in its cash book bank column balance in its books of account. Because this is a payment made by one of the business unit customer and the business unit gets a complete information about this transfer after it receives the bank statement. So the business unit will debit its cash book bank account balance by the amount of this payment. So both the debit balances will add up. When cash book has overdrawn credit balance. After receiving the bank statement, when the business entity know about the deposit that is made directly into its account and the bank has also credited the business entity bank account balance by this amount, so the business entity will now debit its cash book bank account by the amount of deposit. So if the business entity have overdrawn credit balance, then this debit balance will be deducted from the credit balance. The third category of differences is errors by the bank. A bank might make a mistake either crediting or debiting an incorrect amount into an account. When this happens, the business unit can ask the bank to correct it and the bank will immediately correct the customer account. So no further action is needed. The last category of differences is errors in the cash book. This includes any bank deposit or withdrawal may be recorded by a wrong amount. A bank deposit or withdrawal may be completely omitted from the cash book. Undercosting or overcosting of any side of cash book. Brought forward balance on the received side of cash book may be written by a wrong amount. Due to these errors, the balance of bank statement may become higher or lower than cash book balance, depending on the nature of the error or omission. This difference have to be eliminated by adjusting the cash book of the company before the preparation of the bank reconciliation statement. Format of bank reconciliation. When cash book has a positive debit balance, there are two formats of bank reconciliation. You can use any one of them. Format 1. In this format, firstly, we will correct our cash book balance by adding or deducting the items that are in the bank statement but not in the cash book, and also any error made by the business. After that, we will take the bank statement balance and will make adjustments in it by adding or deducting the items that are in the general ledger cash book but not in the bank statement. Then the corrected bank statement balance will match with the cash book balance. Format 2. In this format, firstly, we will correct our cash book balance by adding or deducting the items that are in the bank statement but not in the cash book, and also any error made by the business. After that, instead of taking the bank statement balance as we have taken in format 1, we will make further adjustments in the corrected cash book balance by adding or deducting the items that are in the general ledger cash book but not in the bank statement. Then we will get the balance of bank statement that will match with the balance of cash book. When cash book has overdrawn credit balance, there are two formats of bank reconciliation. You can use any one of them.